Now we're going to look at the U.S. and we want to talk more about what is happening with retail sales. What are some of the recent data sets that have come out? When we start turning to some of the different shifts on worker pay, what does that mean going forward when we're starting to talk about, the rest of 2021 into 2022? So when we start turning to, first we want to look at global manufacturing PMIs, because when you look at that, you're also talking about what is the U.S. importing, what is the U.S. going to be able to export, where is the manufacturing side? When you look at, coming to the other side of that peak growth, and you can see how things really started to peak out in March and May and have since started to decline in July, where, as we've seen so far in August, especially in Asia, you see some PMIs decreasing versus increasing, which is pulling down, just again, kind of measuring that global manufacturing level and just that global economy. Because how can the global economy continue to grow without, China's continuing to slow? We're going to talk about that in a minute in segment 5, but we continue to see these pressure points, and this is one that I think is being ignored within the U.S. So then when we look at gross domestic product, you can see that gross domestic product obviously at the high, but another way of looking at this, in the last 20 years, GDP has increased by $12 trillion, while debt has increased by $23 trillion. So when we remember back to, we did a bunch of shows on China's debt, and we were talking about essentially failures in just lending. So when you lend, debt going up by 23 trillion, and then you have a GDP of 12 trillion over that time period, well, that meant that you invested in things that didn't not only just get back to principal, but also yielded growth. So you're starting to see this essentially in bubbles. They both look bad, or you could say 12 trillion is still number one in the country, in the world, still growing, but to what effect? What is driving that? And if it's being driven by unsustainable debt, as when we look at China, well, aren't we just doing the same thing? Aren't we putting ourselves into the same situation where this debt will then become that bigger and bigger overhang and be essentially a cap to whatever our growth could really become? So then when we take this and look at the budget, the U.S. Treasury budget, well, the budget deficit as a share of nominal GDP widened out in July, now 12.6%, up from 11.9% in June. So when you look at, the infrastructure projects, you look at the different stimulus plans, this all needs to be financed by debt because, we're well above tax receipts. So you're going to need to see this come through in terms of debt. But when you look at just continuously running a deficit, so that means that you not only have to roll your current debt, but then also increase the amount of debt you're issuing, leading to, again, this negative investment cycle where GDP is not growing above, but rather below what the rate of debt is. And you have to get off that cycle. Otherwise, it's just going to bury you because you're essentially growing and sacrificing long-term growth to try to generate some short-term pop. And I say that not because you could blame COVID. This has been happening for years. This is not just a new comeuppance of, well, it's a COVID issue, so that's why we did it. No, this is systemic. This is a big problem that somebody has to get serious about, whether it's the administration, the Federal Reserve, both preferably, have to get serious about where are we going to do this? And the Democrats have to say, look, we need to cut programs. And the Republicans have to say, I agree, but we also need to raise taxes in some areas until we get to the other side of this. And I think that is where that starting point is to come up with a means or using tax revenue better. Where can you cut? As I talk to my Democrat friends and people, you look at Twitter, you look at Facebook, it's very easy to think there's only a polarizing side. There isn't. There are a lot of independents. There are a lot of middle-of-the-road individuals. We just need to agree on the facts and say, these are the facts. Now let's come up with ways to fix the problems with these, knowing these are the facts, because everybody right now is operating on their own assumptions, on their own facts. And this is what we have today. We're seeing it play out in the failures of Afghanistan, in the failures of the COVID response. I mean, look at just the booster. Like, you need a booster shot. No, you don't need a booster shot. Well, maybe you do. Well, you do, but we don't want to give it to you yet because we want other countries to get vaccinated first, which that is probably the right answer. Just say that. Just say you'll eventually need a booster, but we want to make sure that other people are taken care of to try to slow the spread and get on with life. Like, just tell the truth. Don't say masks don't work and then reverse it. Say, we don't have enough PPE. Please stay indoors. The supply chain will catch up and everybody will have a mask. But again, these are failures that continue to come out in terms of the way things are going, in just the way the governments are run. But when you look at the year-to-date federal budget deficit, this is what we're seeing right now, and you can just see the general growth. So you'd like to think that 2020 saw the biggest, but as we get into July, that's where, even though 2020 is still bigger, you're still seeing 2021 maintaining its very strong growth, which again is just going to draw down draw down reserves, require more debt, and again, becoming a bigger issue. So then when we look at some of the important issues facing small businesses, so availability of labor is not the only issue. And this is what we keep talking about. It's the quality of labor. Because when everyone likes to talk about the issues that we see, the problems that would remain, and it's like, oh, well, there's all these people who want jobs. They're just not getting jobs because they don't want them. Well, there's also a quality side. And there's a pickiness on the company side waiting for the best quality of labor. So as shown, single most important problem for small businesses is availability of skilled labor. Also, there are not demand issues, given poor sales are the least important problem. So it's not because their sales are weak, because they're not. It's just there's cost and there's quality of labor. And those are the two biggest things that continue to be the hindrance of bringing on additional people. But when we even look at that, worker pay has fallen in 2021 when adjusted for inflation. So inflation keeps going up and wages are not keeping pace. So even though you have wages at the lowest level increasing, they're still not keeping pace with where we are today on the inflationary cycle. And again, this becomes a much bigger issue because with prices so elevated on an inflationary level, well, if I pay that individual more, I'm going to have to increase my prices to try to recoup some of the cost, which is going to increase my price further, which is then going to require me to pay that person more because I'm not going to be the only one doing it. So then other inflationary pressures are going to come up, and you can see how this spirals very quickly and it compounds on itself when we're looking at these underlying problems, which haven't gotten any better in July or early August data. So then when we look at the 1 month and 12-month change, this is what we're looking at in general. So changes in real average hourly earnings for all employees and production and non-supervisory employees. All employees, you can see, all employees 12-month change is down 1.2%, and all employees 1 month change is down 0.1%. Now, again, this is just showing just how much pressure is under. So when we look at those savings and you look at just when the things went negative as prices continue to climb higher, this is that drawdown on wages. This is that drawdown on savings, that you're not going to get this pent up demand. It's just the cost of doing normal activities becomes more expensive. So then when we look at small business job openings, hard to fill, you can see that they're at records. Why? Because they can't find people. And that is, so we continue to see this conundrum that plays out that we keep trying to highlight on different levels, showing some of these underlying problems. And then when we look at the city economic surprise, so when we're looking at the US, Eurozone, and China, you can see that Chinese economic data continues to surprise to the downside. The US is now firmly negative, and the Eurozone has continued to weaken. Now, that's some pieces, and as we keep talking about in Europe, some, especially really Italy is the one that keeps surprising to the upside, where Germany is either in line, slightly above, slightly lower. France is slightly worse. Spain is a little bit more, a little bit worse. Better say it than that. Worser doesn't really make sense or sound right anyway. So when you look at this, this is where you keep seeing the data sets, because expectations remain so elevated, and they're rolling back because the data is not supporting the narrative. And that's where the narrative, there's going to have to be this merge of data and narrative to really make this make sense. And this is just pulling out now, looking at the G10 economies. The surprise index is now negative again at negative 9.2, which is showing again not just China, not just the U.S., but the G10 is seeing this surprise to the downside. And when we look at retail sales, in the U.S., you had a big swing and a miss. So when we're looking at retail sales coming in at negative 1.1%, we have to consider, well, what were they supposed to be? So when we look at retail sales were supposed to be down 0.3%. Instead, they're down negative 1.1%. Then you start taking out less autos. Less autos were supposed to be up 0.2%, came in at negative 0.4%. So you're seeing then the retail control group was supposed to be supposed to be down negative 0.2%. Instead, it came in at negative 1%. So this is where you're seeing this consolidation, but it's looking month over month. So on a net dollar basis, it's still up on a dollar value, but it comes down to value versus volume, because the value of retail purchases is still high, but so are prices. So that just means that in the past, I could buy 2 boxes of pasta for the price that I'm buying 1. So I'm still buying the same dollar value, but my volume has diminished. And that's when you start coming to quality of life, the pressure at the other side, because it's 5 people in my family, a pound of pasta goes quickly. So you start to see how it can compound on itself over that time period. So then when we look at it, July retail sales were weaker. Sales took a hit from the from autos, but ex-autos still weak. So then when you look at just the net value, that's $617 billion. So we're still elevated. We're still above where we were in 2020 in terms of the adjusted sales total, but it comes down to what is that value side versus the volume. And that's when you start looking at U.S. retail sales fell in July, as you're starting to see the shifting preference in terms of some of these movements of, I'm going to buy a little bit more services and a lot less goods, and you're starting to see that pivot, but goods cost more than services. So you're also seeing price increases. So technically we should see this come down, but we're not, due to obviously the inflationary pressures. And this is coming to some of those different pieces of, store retailers, gasoline stations, food services, but everything else, motor vehicle, non-store, clothing, building, food and beverage, general merchandise. So again, you're starting to see some of that pivot as the rotation continues from goods to that service side. And that just gives you an idea of where. But now let's look at durable goods spending versus leisure spending. So leisure spending starting to come back up, all else, but leisure spending starting to peak up a bit, but durable goods spending has been in a very steady downtrend when you're looking at this moving average and you're seeing some of the pressure points come in and all else. Again, just that number coming down, but what is the change? What is the spending itself? Percentage-wise, it can be up, but again, volume versus value becomes a bigger issue. So then when you start looking at just what are Google searches saying? Well, based on Google searches, retail sales shouldn't be going down or up all that much. They should be pretty much stable. So likely retail sales likely impaired by the Delta variant, which is probably some of that, but consumers' intentions to spend slowed into early July before rebounding in August. Search activity tends to lead by a number of weeks. Any further weakness potentially short-lived, because what do we have? Back to school. People are starting to panic about Christmas already because of these supply chain issues. So again, you're going to see some of that pulled forward and streamlined over that period. And when you look at the search activity, it's not supportive of this downturn remaining. And you remember, consumers also remain, very mobile. Spending may have slowed, but consumers are not yet willing to stop going out. So even if you didn't buy anything, or maybe you bought less, you still went to the store. So that's one of those pushbacks. When you look at business inventory, though, Business inventory at the retail side, still based on this chart, still at the lows. Wholesale, manufacturing, again, all of that speaking to inventory to sales, being beholden and trying to pull in more capacity as global schedule reliability continues to worsen. When you look at just what the reliability is, we're still now, just at about 40%, given the fact that you have no idea when something's going to get there, just because obviously your schedules are impaired given all of these underlying issues in the supply chain with, ports remaining shuttered in Asia, especially in China, again, limiting some of this additional value flow. U.S. retail, recreation, sustaining recent activities. So even though people are buying a little bit less retail-wise, you're still seeing people go out and move about, which again is providing some of that support for some of the gasoline demand, which is why I'm saying things are slowing, but we're going to get one last pop before we start to see some of that come off. But then on the U.S. industrial production side, which stronger in July, came in at 0.9% versus an estimate of 0.5%. And then when you look in notable rebound in auto production, which if you look at just the backlog, there's a lot of reasons to kind of get things back to normal. And we're pretty much right back to where we were pre-COVID, which again is not surprising given just the amount of shortage in inventories and the demand that we have seen come back. We had to get back to some of this level, given, just as we said earlier, the amount of shortages in storage. So then when we look at University of Michigan, even though, prices going up, wages under pressure is going to eat into how the consumer views the world. So when we look at the Michigan Consumer Sentiment Index, came in at 70.2, back to the lows that we saw from during COVID. Current economic conditions continue to worsen as well. Then when we look at consumer expectations coming into the lows again. So you're seeing again a lot of the pressure points on how people feel internally on sentiment index, on economic conditions, and expectations are getting worse, all the while their expectations of inflation continue to drift higher. So then when we look at, the expected change in prices during the next year, you can see they're still at elevated levels, slightly off highs, but people still see what's out there, still expect to see prices going up. And then over the next 5 to 10 years, again, shifting higher. And I think that's when you look at supply chains, you look at offshoring, you look at what, people are seeing, you continue to see these underlying pressure points. But when you look at, on a different side, the Langer U.S. Weekly Consumer Comfort rebounded off the lows, but still, not getting back to where we were at that peak. So again, you're just looking at multiple data sets. In general, there was a bit more hesitancy now, and it's coming from all these price increases, which when we turn to financial situation, the University of Michigan sentiment in August was incredibly weak. Headline index fell to the lowest since 2011. Consumers' prospects for their financial situations 1 year ahead have continued to fall dramatically, worse since 2014. And the real household income in 1 year falling low because of inflation. So as inflation stays elevated, that's going to pull down your real household income. So then when we turn to buying conditions, again, leading to sentiment, buying conditions for vehicles, back to the lows that we haven't seen since the 80s, for house and vehicle. Again, strain for vehicles lowest. So I'm sorry, for vehicles, it's the lowest in history. For homes, it's the lowest since 1982. So there you go. So then when we look at University of Michigan consumer sentiment versus expectations, it's the widest divergence we've had essentially going back through 1999 as the sentiment and expectations continue to see some of this bifurcation, which we've seen here, where investor sentiment continues to be at all-time highs. If you just look at it from the way the S&P 500 moves, given there's a lot of things that go into that, I just thought it was a fun chart to kind of show where some of these impacts are as consumer confidence falls. Sentiment continues and remains elevated. Again, seeing this steep bifurcation of the differing parties, which is going to be something to see on. Do they meet in the middle? And the answer is yes. One won't come all the way down, one won't come all the way up, but there's going to be some convergence over the near term at some point. And now in the next segment, we're going to go through a bit more detail on what's happened with Delta and what does that mean for some of the economic data, as we go through, again, out of summer and into the remainder of the year.